Let's go ahead and go through an example of lessor accounting, and let's use the same 2-year example we used for the lessee. And again, the same example was assume that lessor company is going to lease a machine to lessee company on January 1st, 2020. The machine has a fair value of $1,000. There will be a $100 terminal payment, either a residual value or a bargain purchase option, and the lessee and the lessor both use a 10% discount rate. Payments will be made at the end of each year. The asset has a 3-year useful life with an expected salvage value of $10. And again, the first thing we have to do is to determine the annual rental payment. We start with the fair value of the asset. We subtract out the present value of that residual and say, look, of the $1,000 fair value, the lessor will get back $82.64 via the terminal payment, leaving $917.36 to be recovered via the rental payments. So this implies a 2-year ordinary annuity at 10% with a present value of $917.36 implies an annual rental payment of $528.57. And again, first we have to determine whether or not this is a capital lease. The lessor faces the same 4 criteria the lessee faced. Does the lease transfer ownership to the lessee? In this case, no. Is there a bargain purchase option? In this case, no. Does the term of the lease exceed 75% of the asset's useful life? In this case, no. Is the present value of the minimum lease payments in excess of 90% of the asset's fair value? And again, in this case, the rental payments alone have a present value of $917.36, which is more than 90% of the asset's fair value, so yes, this will be a capital lease under criteria number 4. Now, in addition to those 4 criteria, any one of which needs to be met, the lessor must also satisfy both of 2 additional criteria. The collectability of the minimum lease payments must be reasonably predictable, and there must be no important uncertainties surrounding the amount of unreimbursable costs yet to be incurred by the lessor under the lease. Okay, so we're going to assume this meets the criteria for a capital lease. Now, from the lessor's perspective, there are 2 subcategories of capital leases. The difference is based on the presence or absence of a dealer's profit or a manufacturer's profit. Under a direct financing lease, the fair value of the asset equals its book value. In this case, the economic motivation for the lease, for the lessor, is simply to earn the interest revenue included in the lease payments. You buy an asset for $10,000, lease it out based on a fair value of $10,000, and earn interest on the lease payments. In contrast, we also have what are called sales-type leases. In this case, the book value of the asset is less than its fair value. In this case, the lessor generates 2 types of income. First, they mark the asset up from cost up to fair value, and then they lease the asset out based on the fair value and earn interest on the lease payments. So this, think of the example of a car dealer. The car dealer buys a new car from the manufacturer for $20,000. They lease it out based on a fair value or retail value of $24,000. So they make a $4,000 markup on the sale of the car, and then they also earn interest on the lease payments as the payments are made. So getting back to the example at hand, let's first assume that the cost of the asset is $1,000, the same as the fair value. And again, to recap the details, remember that the cost equals fair value equals $1,000. It's a 2-year lease with the payments at the end of each year. There's a $100 terminal payment. There's a 10% interest rate, and annual payments are $528.57. Now, when the lease is originated, the lessor is going to report a receivable, lease payments receivable, for the present value of everything they expect to receive. We also assume that this is the fair value of the asset. Remember, that's how we computed the lease payments, so the present value of everything the lessor expects to receive should equal the fair value of the asset. So we'll go ahead and record a lease payment receivable for $1,000. We also need to take the asset off of the lessor's balance sheet. So assuming this is a machine, we credit machine for $1,000. Now note that the $1,000 lease payment receivable is the same whether the terminal payment is a guaranteed residual, an unguaranteed residual, or a bargain purchase option. This $1,000 is the fair value of the asset, which by definition will be equal to the what the present value of what the lessor expects to receive. Okay, so they record their receivable, they take the machine off their balance sheet, and now we're going to go ahead and collect the payments over the next 2 years. At the end of 2020, we collect our first payment of $528.57, and just as we did for the lessee, we're going to split that between interest and principal. Interest, 10%, the discount rate we're using, times the beginning of year lease receivable balance of $1,000. So of that $528.57, $100 is interest revenue. The other $428.57 is the lease receivable being paid down. At the end of the second year, same thing. We get a check for $528.57. Interest revenue will be 10% of the receivable balance. Again, we started with a receivable balance of $1,000. We paid that down by $428.57, leaving us with a receivable balance of $571.43. 10% of that is $57.14. The balance of that cash receipt goes to pay down the receivable. The receivable now has a balance of $100. And again, that represents the terminal value we expect to receive, whether in the form of a bargain purchase option price or the return of the asset. Okay, again, now at the end of the 2 years, the receivable has a balance of $100. That represents the terminal value the lessor expects to receive. And so let's go ahead and run through the various possibilities. First, if it's a bargain purchase option, the assumption is that the lessee will exercise the option writing a check for $100 to acquire title to the asset. So we'll get a check for $100, and that will pay down the balance of that receivable. If there's a guaranteed residual value, we're going to get the machine back, and if it's worth at least $100, we'll go ahead and record the machine at $100, and that pays down the receivable. If it's worth only $80, then we'll record the machine at $80, and since it's guaranteed, the lessee is going to have to write us a check for $20 to make up the shortfall. It's important to note that in the case, in the second one there, where we debited the machine for $100, we record the asset that's being received at the lower of either its fair value or the receivable balance, the investment that we have in that lease. We would never recognize a gain on that asset. Okay, now let's assume the residual value is unguaranteed and assume the asset is only worth $80. Again, in this case, the lessee is not responsible for making up that shortfall, so that $20 is going to be a loss to us. And again, I want to stress again that when the asset is received, we record it at the lower of either its fair value or of the receivable balance. We will never show a gain on the return of the asset. In other words, if it's worth $140 when it's returned, we would ignore that $40 increase in value. Okay, now let's go ahead and assume this is a sales type lease. Again, exact same lease as before. The only difference now is that the cost is $800. So since the cost is $800 and the fair value is $1,000, this is going to be a sales type lease, and we're going to have to view this as a sale of an asset essentially on credit. So we're going to have sales revenue, and the sales revenue is going to be the fair value of the asset minus the present value of any unguaranteed residual value. Similarly, the cost of goods sold is going to be the book value of the asset less the present value of any unguaranteed residual value. So first, let's assume that the residual value is guaranteed, or that there's a $100 bargain purchase option. We'll go ahead and record the receivable in the same manner as before. We take the machine off our balance sheet in the same manner as before. We record sales revenue, and again, this is the fair value of the asset minus the present value of any unguaranteed residual. There is no unguaranteed residual, so it's simply the fair value of the asset. And likewise with cost of goods sold, it's the cost of the asset less the present value of any unguaranteed residual, which doesn't exist. Now, this looks a little intimidating at first until you realize that 3 of these accounts are going to go away. The sales and the cost of goods sold, those are going to get closed to income summary, and we won't see them again. They go off, and they go right off into the sunset. The machine account we're taking off the balance sheet, so really all we're left with after the closing entries is that receivable, which we're going to collect over the next 2 years in the usual fashion. Now, if the residual value is unguaranteed, what we're going to do is, again, we record the receivable at the fair value of the asset. We take the machine off the balance sheet at its book value, but we're going to reduce both sales and cost of goods sold by the present value of that unguaranteed residual, $82.64. Now, note that there's no change in the gross profit. In the first case, we had $1,000 minus $800 cost of goods sold for a $200 gross profit. In the second case, we've got sales revenue of $917.36 minus cost of goods sold of $917.36 for a gross profit of $200 also. We've simply reduced the revenue and the cost of goods sold amount by the same amount.